What's happening, Hardscapers? This is episode 285 of the How to Hardscape podcast, where we talk about how you can start and grow your hardscaping business. And on today's episode, we talk about overhead recovery systems. We bring back 3 previous episodes where we talked about specifically overhead recovery systems. We have Jim Huston, who talks about, I believe, 4 different overhead recovery systems and why you should not be using multiple overhead recovery. And I also have an episode where I followed up on this, talked about how we do overhead recovery, especially with the How to Hardscape headquarters software. If you're looking for a budgeting, estimating, job costing, scheduling, time tracking, course content area for training and onboarding employees, managing employees, we have that all in the headquarters software. You can go to hthheadquarters.com to learn more about that. And also my thoughts on that second episode of overhead recovery and why I do not like multiple overhead recovery, because I don't like materials dictating my pricing besides actually covering the cost of those materials. You can also get very much in over your head with doing multiple overhead recovery because there's so many variables that you need to predict in your business. And then unless you're doing the same thing over and over again with the same materials, same project, which I would say nearly 100% of us do not do in this industry, then multiple overhead recovery is not for you. And then in the third part of this episode, we have Weston Zimmerman of Synced Up, and he talks about overhead recovery systems as well openly with me. And it was a great in-person interview, something that I do not get to do a lot of. So I appreciate all of my guests' time that we have on the How to Hardscape podcast, and everybody that listens here. This is the end of year episode, so I want to say thank you for continuing to listen into the podcast as well as future episodes. We've got a lot of great things lined up for 2025, and I'm looking forward to it, and I hope you are too. We want to say thank you to our sponsors, Cycle CPA. And if you're looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know How to Hardscape sent you for money off their services there. Knowledge Tree Consulting, if you are looking for somebody to help you in your business, I would highly recommend Knowledge Tree Consulting. They are efficiency consultants in our industry, and you've heard them on the podcast multiple times before. George and Peter of Oriole Landscaping, and George a couple of other times talking about various topics, and we'll definitely have George on in the future to talk more. But you can learn more about them at knowledgetreeconsulting.com. If you haven't put a lot of thought into your 2025 budget just yet, I would highly recommend considering what overhead recovery system works best for you in your business, and I hope that this episode helps shed light on that in some way for you. And if you want any help, you can reach out to me at How to Hardscape on Instagram, or you can also book a demo for our software, and I'm glad to help you out anyways through that. That's hthheadquarters.com. But without further ado, let's get into today's episode. This is Jim Huston on overhead recovery systems. Now, I want to talk about overhead recovery systems with you, Jim. It's something that has been on my mind quite a bit lately. And myself, I've got my own opinions on it. And I did come across a resource of yours online. It must have been a speech that you gave back a while ago with Landscape Ontario, where you talked about 6 different overhead recovery systems and getting into them. So it was great reading material. You also have your own book on your website there. I don't know where you kind of want to start with this discussion, but overhead recovery systems methods. Do you want to cover as many as you want, or do you want to focus in on one? But I do want to talk about specifically multiple overhead recovery systems and your thought on that.
Yeah, there's also another seminar. It was actually a panel discussion with Landscape Ontario, I believe. It was in Toronto, and it was probably 7-8 years ago. And they built it as a job cost smackdown. And I had no idea what this was about, but it was going to be a panel discussion during the lunch period. And even I get up there, I have no idea what this is going to be about, but I showed up. And I get up there. There was a panel discussion with Chuck Vanderkoy, Mark Bradley from LMN, and another contractor who I can't remember who it was. They're all using the Moore system. Okay. And anyway, and so I'm sitting there and I'm thinking, where's this going to go? Anyway, so Mark was the moderator. And in the federal lunch period, we're on a raised panel in the platform in the front. And I look in the back of the room, and there's a big banner that says Job Costs Smackdown. They had a pair of boxing gloves. And I go, now I know what they want. And so we had a really robust discussion about this. They may have recorded that. I'm not sure, but you get a chance to go back and take a look at it. But it was really a lot of fun. I had just come out with my new book back then of it's called A Critical Analysis of the Moore's Estimating System. I'll hold it up here for a crass commercial here. I don't know if you can see it here, but it's available on my website. I also have an audio book to go with it. But anyway, I think the best way to approach this is to sort of quickly review the commonalities of 4 of the 6 estimating methods. Okay. And here they are. They're factoring, materials times 2. There's the SOARS method, the single overhead recovery system. There's the DOORS method, the dual overhead recovery system. There's MORES, the multiple overhead recovery system. Then there's what I call market-driven unit prices, where you just grab unit prices that are common in the marketplace, so much per square foot for pavers, times, okay, this is a 300 square foot paver patio, $20 times 300, $6,000, there's my price. So you're just sort of grabbing prices out of the air from the marketplace. And then there's finally, my methodology, I call it the overhead per hour method. Some people call it the field labor hour method on there. But what's interesting, you've got factoring, SOARS, DOORS, and MORES are all using factoring on here. And what I mean is that factoring is a mathematical term. And for instance, if you take the formula 2 times 3 equals 6, and the 2 and the 3 are factors, the 6 is the product. So if you have the old saying, materials times 2 for a construction job, materials times 2, the materials cost and the 2 are factors, the price is the product. Well, the problem with materials times 2 or materials times 3 or whatever, number one, you don't account for your greatest risk factor, which is labor hours. And that's critical in all this analysis, is that labor hours, I'd say, present 90% of the risk in your business on that, field labor hours. So factoring doesn't account for, except for the materials cost, that's all. You can't job cost it. You can't monitor your most important risk factor, labor, on there. Overhead is just assumed to be part of that whole thing. And so this is where factoring is extremely inaccurate, but it's the common denominator with SOARS, DOORS, and MORES. Now in SOARS, single overhead recovery system, and a lot of CPAs promote this, and it can get you into a lot of trouble, but you simply add up your materials, your labor, burden, maybe equipment, come up with your direct costs, okay? And then you bump it up, 30, 40%, And so hence this one markup percent single overhead recovery system. And that can get you in a lot of trouble because you're taking the total of the direct cost and multiplying it by, like I said, a markup percent. Well, it doesn't identify the labor. It does identify the labor, but the problem is it's treating labor, materials, and equipment all the same as far as direct costs are concerned on here. A little later, I'll maybe get a chance to explain why this system can get you into serious trouble. Anyway, so then we get into DOORS, the dual overhead recovery system. And in 1993 or 4, NALP, that was then ALCA, published a book called Pricing that promoted this system. Well, and again, they're using 2 percentages, 1 times material, 1 times labor. But one of the big fallacies in DOORS is that all of your equipment costs are put in overhead. And that can be a serious problem. Okay. Well, so anyway, so you have stores, you have factoring, stores, doors, and then somebody came up with this multiple overhead recovery system. They saw the flaws in factoring, they saw the flaws in stores, saw the flaws in doors. Well, we're going to use 4%, and usually the percentages are to mark up the direct cost. You're going to mark up your subs 5%, then add profit on top of that. Materials, you're going to mark it up 10% for overhead plus net profit. Equipment, you mark up 25%, trucks and equipment, 25% plus profit. And so the markup on labor is derived from a formula where you basically what's left over for overhead recovery, you put against labor. And so that percent usually comes out to be between 35 and 95%. So we would do a budget, and this is basically the Vanderkoy system, or Moore's. He's the guy that promoted Moore's, made it popular through his workshops and stuff. And I taught this method for 3 years when I worked with him back in the late 1980s. Okay, and then, so anyway, so but here's the problem, especially with Moore's, is that the 5% on subs and 10% on materials, 25% on trucks and equipment for overhead recovery, those numbers are totally arbitrary. They absolutely have no mathematical justification whatsoever. When I was working with Chuck, we're on a flight from, I think, Chicago to Denver, and we're sitting beside each other. And so I asked Chuck where those numbers come from. He hemmed and hawed and whatever, back and forth. And I realized that these numbers are just pulled out of thin air, and they mean nothing. And so anyway, and so if the markups on subs, material, and equipment are arbitrary, there's no mathematical justification. Well, and because the markup on labor is derived from those three, it's totally arbitrary as well. It has no mathematical justification. I tell people in any system, cost estimating system, number one, the goal is to estimate your cost accurately, number one. And number two, every number that you use in your bidding process, you should be able to mathematically justify on here. In other words, you should be able to say, okay, if I'm putting so much cost for labor in a bid, well, how did you come up with that number? Or what about the cost per hour for a truck or a skid steer or a mini excavator or a mower? You should be able to go back and reverse engineer that number and see where it came from. Well, with Moore's, these numbers are basically totally arbitrary. They're pulled out of thin air, and they have no mathematical justification on that. And so that is the big problem with Moore's or any percentage-based system. Where do these numbers come from? And people can't explain that. We get these numbers out of a book, and where is that? Where do they get those numbers? Well, ultimately, you have to accept these numbers on faith. I call it faith-based estimating. It's like you're going to be a true believer here. Glory to Jesus or something. I don't know, but you got faith-based estimating. Sorry, Jesus. And but anyway, but remember, he says to count the cost, and so we got to count the cost. But these systems, and what I'm looking for in these systems is where they estimate a cost inaccurately. The $5 million company he's talking about, he had a fatal flaw in his the way he allocated equipment costs to his jobs, and eventually it cost him his company. So I'm looking for areas where people are basically have an inaccurate method for calculating their cost in these bits. I'll give you a quick example about why the 5% markup on subs just isn't accurate. And you can apply this to the material markup of 10% or the 25% on trucks and equipment. The probably 25, 30 years ago, I get a phone call this is the early 1990s, and from a guy named Mike back in Pennsylvania. And he's a client, good guy, and we work together. He says, Jim, I've got a bid here that I need your help on. He says, I'm going $36,000 worth of in-house work. My crews are going to do it. I know how to price that. I feel comfortable with it. But I've got a $100,000 sub that's going to come in. It's going to, clear and grub this ballpark area. They're going to, grade it, seed it, put jute netting on it. It's going to cost $100,000. And I'm wondering how much I should mark it up. I said, well, Mike, what were you thinking? He says, well, the Moore's method says 5% for overhead and 10% for a profit. And he said, yeah, about 15%. I said, well, Mike, how difficult is this subcontractor going to be to work with? In other words, how much supervision are you going to have to provide for this subcontractor? He said, I've done a lot of work with this guy before. He's a great contractor. He says, when it really comes time for him to do his portion of the job, I'm going to make a phone call, tell him to get started. He's going to do the work, and then I'm going to send a bill, for when he gets done. I said, well, let me make sure I understand this. You want to charge 15%, $15,000 for making a phone call and preparing an invoice. He goes, well, yeah. And I said, I'll tell you what to do. I'm a consultant. I'm here to help you. I'll either do the phone call or prepare the invoice, and we'll split the $15,000. So he chuckled. And I said, can you charge $15,000 for making a phone call and preparing an invoice? Well, if you can, I'd do that all day long, And just think about, one a day or even one a week would be some pretty good money. And so anyway, so he started, he realized that those percentages, the 5%, especially on the market, made $5,000 for overhead, which would be making a phone call and sending an invoice, dramatically overstates the true cost of what he'd have to do. Now, and again, if I can get 15%, $15,000 for that, that's fantastic. But in his market, he realized he probably couldn't get away with that. But my point is that percentage, the 5% markup on subs, totally arbitrary, has nothing to do with your actual cost structure. You make the same argument for the 10% on materials. And I mean, it's and in my book, the critical analysis of the Moore's estimating system, I really get into this in great detail. And I said, listen, that 10% markup on materials, again, it's totally arbitrary. Maybe you have a supervisor on the job site who's billable, direct bill to the job, and he's ordering all the materials. And then, well, you don't have to mark up the materials, in this case, because it's already charged for his time to, prepare the purchase orders and all this sort of stuff, process the material and stuff. The one that really baffles me is the 25% markup on trucks and equipment. I mean, where does that come from? And so this is the core problem with Moore's, is that it simply does not calculate your overhead cost accurately when it comes to these different categories. And I talk about it in the book is that any time for overhead recovery that you are calculating that by multiplying your direct cost by a percentage, you're automatically making a mathematical mistake on here. And so this is where my problem with these different methods is not that I don't like them. I mean, it's just that they're not inaccurate. That's the issue, being accurate with your information and your data on here. And I give you a couple examples of how this flaw works itself out. And for instance, if you look at the categories for general administrative overhead cost, basically there's about 25, 26, 27 different categories. And, advertising, marketing, you've got rent, you've got all your office staff and overhead staff. You've got some of the other big ticket items. There aren't that many other than that. But you got your rent, advertising, marketing, You got overhead vehicles, the vehicles that the overhead staff utilize. So all of those items usually come up to about 25% of your sales. So if you're doing $1 million in sales, your overhead is probably around $250,000. Half of that is for overhead personnel on that. And so this is where, if you look at the categories, about 85 to 90% of every cost in general administrative overhead is incurred and paid based on a time unit. In other words, how often you pay your rent? Probably once a month. How often you pay your office staff? Every week, every other week? Okay. But it's based on time. And so so as I look at all that, I go, okay, 25% of your sales are probably the amount your overhead cost is. $1 million company, $250,000. And then 85, 90% of those things are incurred and paid based on a time unit. And so this is where now we're getting into, how do we take that $250,000, and obviously we want our clients to pay that. Okay, I mean, we're just going to take it out of our pocket. The question is, how do we get that into our pricing and pass it on to the customer? And so and this is where, when I'm looking at those numbers and I'm looking at how I'm going to do that, I realize that these different methods, whether it's my method or these, factoring, stores, doors, and mores on here, basically, again, I'm looking for the inaccuracies in that. But here's the dirty little secret, is that there's something more important than that methodology for allocating overhead that overrides all of this on here. And so what I've noticed in the marketplace in the last 37 years is that you need to be, for the different products and services that you provide, projects and services, that they have a gross profit margin that as a benchmark that you need to shoot for. In other words, let me give you some examples. Gross profit margin, of course, is the total of your general administrative overhead costs in a bid plus your net profit. Okay. In a normal economy, if you're doing residential landscape installation work, now I'm going to take the subs out of this because that's going to distort things, but just for the in-house work you're doing, no sub work, your gross profit margin on that work should be about 40%. In a normal market, in a robust market like we currently have, 40% is not a bad number to shoot for. Bigger jobs, $300,000, $400,000, $500,000 projects, residential projects, maybe you're going to lower it down to 35%. So you get some economies of scale there. But so I don't care how you allocate the overhead to a bid. I'm going to add up all the overhead and the net profit in there, and then I'm going to look at the gross profit margin that you're putting on that work. And so it better be around, that 40% number. And again, you can use my method, you can use Moore's, doors, source, whatever. The key thing is to monitor that gross profit margin. Okay. Now we get in a recession, that number is going to drop 10%. You're probably down to 30%, maybe even down to break-even point on here. Now, let's talk about the commercial landscape installation market. That market, usually your gross profit margin is going to be 25% plus or minus 5%. Okay. If you are negotiating work, in other words, you're the favorite contractor, if your price is reasonable, you're going to get the job, you want to bid it mid to high 20s. Okay. If low bid take all, you want to bid it mid to low 20s. You only get one shot at it on here. And so this is why you want to negotiate as much work as possible in the commercial installation market. If you're bidding maintenance work, whether it's commercial or residential, your gross profit margin is probably 35 to 40% on here. Lawn care, fertilization work, up around 50% gross profit margin. Irrigation service work, 50%. So this is where all these methods of allocating overhead are secondary compared to monitoring your gross profit margin. I almost don't want to say that because I popularized my method, and the thing is that I think it's the most accurate way to do it. It's the most easily way to measure all this stuff. But this is where when you start monitoring gross profit margin, then now you're really getting down to the nitty gritty, and it's sort of somewhat superfluous arguing over, well, how did you get that gross profit? Well, that makes sense. On sub work, what I've seen is generally people who are subbing out work, they're marking up that work from 10 to 20% normally. 15% just seems to be the average on that. I like to put it on as a margin versus a markup. In other words, I'm going to take the total of my sub cost divided by 0.85. That gives me a true 15% margin on that work on there. So this is where I think we can get involved in all these discussions about G&A overhead, but the important thing is, how do you define it? And don't put your field equipment and crew trucks in there. Keep that out of there. And then it's a question of how do you get it into your bids and your pricing on here. And so again, I disagree with Vanderkoy's method of Moore's. I think it's inaccurate, and I can show it mathematically why it's inaccurate. Same thing with doors and stores and factory on here. But I tell, because a lot of software out there does not give you the option of using this field labor hour method that I use. They only have used the Moore's methods, and these people have no idea where those numbers came from or if they're accurate or not. That's what they do. And so I said, okay, you're using that type of software that only allows you to use percentages. Let me show you how to calculate that on there. And so I go in for a lot of people, a lot of contractors, and show them how to use their software. And it's interesting. It takes me, I call it calibrating their software system. And once I show them what we're doing here, it makes total sense. And then they're off to the races with good, consistent pricing.
So talking about systems of overhead recovery being secondary to monitoring gross profit margin, what about net profit margin? Where does that come in? Or is that more like a job costing aspect where you're looking at gross profit margin when pricing a job and then net profit when you're job costing to see where you were? Because companies can get really carried away with their overhead and find that their gross profit margin is at that benchmark. And then after the job is completed, where's the net profit?
Sure. On the front end, usually net profit margins apply to the different types of work. For maintenance, residential, commercial maintenance, normal maintenance, you're probably going to be, your net profit will probably be 10 to 15%. If you're doing residential design build or bid build work, I want to usually put at least 20% net profit on my break-even point. Break-even point being the total of your direct cost plus your general administrative overhead. So 20% for residential installation work. Commercial work, installation work, usually 10 to 15% is a good benchmark to start with. Now, if you can get more, by all means, get more on here. Fertilization, I usually try to get 25% net profit. Same thing with Christmas decorations. Irrigation service work, a minimum of 20% net profit on here. And so these things, these all add up, and those are some pretty good benchmarks to start with. And again, if you get more, if you can, by all means, get more on there as well. Those are generally some pretty good things in a normal economy. If we get into a recession, people are going to knee-jerk down to a break-even point. They panic on here. And break-even point is just you're only covering your overhead cost plus your direct cost for materials, labor, and equipment. And And then people tend to knee jerk down to that break even point in a recession for that.
Why not put equipment into overhead? And what problems arise, like you said, when companies try to do that? They put their equipment into their overhead costs there.
Sure. And again, the dual overhead recovery system, that's what they do. Your equipment cost with the depreciation usually runs about 10 to 12% of sales. Doing $1 million, your total of all your truck and equipment costs probably $120,000. When you put it into overhead, now you're averaging that cost on your jobs on there. And this really comes out in a recession. And and so if you're taking your truck and equipment cost and average, putting it all in overhead, you're averaging it. Well, what happens is you have some jobs that all you need are pickup trucks and wheelbarrows out there. But if you've got skid steers, mini excavators, and all that other stuff out there, you're putting an average cost for that in there as well. So you're overstating your overhead in that situation. Okay, well, that drives your price up higher. I'd rather be too high on that price than too low. The problem comes out when you have a job that you need your mini excavator, you need your trencher, you need your skid steer, all big trucks, whatever. So now your average is too low on there. And guess what? If you underprice your work, you're going to get plenty of work. And this is where a lot of people just haven't figured that out. But that's what happens. When I was talking about the guy in Boston, the $5 million guy, what he was doing, a consultant taught him this 30 years ago. He was basically taking his truck and equipment cost, which was $817,000 of his P&L. Let's call it $800,000. So on that $800,000 in cost, he had 80,000 billable hours in the field. So the consultant taught him to say, divide the $800,000 in truck equipment cost with depreciation and divide it by 80,000 labor hours, that's $10 an hour. So if you have a job that has 1,000 hours on it, for a truck and equipment cost, take the 1,000 hours times $10, $10,000. That's how much you can put in there for a truck and equipment cost. And there was the fatal flaw. So again, if he had a job that only required pickup trucks and wheelbarrows, instead of $10 an hour, he probably needed to be about maybe $4 an hour. And so he was overstating his jobs, 1,000 hours by $6,000. Hey, if you can get it, great, but in a competitive market, you want to accurately identify your cost and really identify your break-even point a lot more accurately. And so in this case, he wouldn't get those jobs. Okay, but the problem was, it was the jobs that required, and he had backhoes, he had big dump trucks, and you get a job that requires all that stuff and more. And here's where he needed maybe $15 an hour average. He was charging 10. He would underprice his jobs considerably. And guess what? He would get those jobs. And so hence when he told me, he said, Jim, the more work we do, the less money we make. I go, well, that's obvious. You have a fatal flaw in your pricing because your pricing is designed to get you all the work that you're losing money on or barely breaking even. And so that's what happened when you put when you average out your truck and equipment cost and allocate it that way. Let me give you an example. Let's say in the U.S. or Canada, where you are, they passed a law. The legislators came up with this brilliant idea that hotel rooms, that they're too variable. We're going to pass a law, and everybody has to charge $100 a night for a hotel room. Well, the Ritz-Carlton, I've seen rooms there for $1,000 a night. You go to Motel 6 or some of these other places where you're afraid to sleep there. That maybe should be like $45 a night. My question would be, well, Mike, where would you stay? Are you married?
I'm married, yes.
Okay. And where would your wife want you to stay?
Oh, she would want the nicer place for sure.
She'd want the Ritz Carlton for $100 a night. Now they're losing money, but the market isn't stupid. If you're willing to undercharge for a service or a project or what a product, you're going to sell lots of them. And so this is the problem. The market ain't stupid, but contractors tend to be stupid. They can't figure this out. And so, the same thing with material. Let's say that for any job, you charge the same amount for material. Now, regardless of what the cost of the material is, you're going to come up with an average. And this is where averages can kill you. And this is why I don't want to put all the construction equipment costs and overhead, because now I'm averaging a cost versus making the cost job specific. That's the critical thing. Again, it gets back to accuracy, identifying cost accurately.
Okay, so could you as a business owner say like work trucks, which are going to go out on every single job, could you allocate that to overhead expense and the things that are always going to be on every single job, but the specific equipment that might go on this job but not that type of job, that's where you would separate those and assign those to specific projects?
No, I would take the only thing I would put in overhead would be the vehicles that the overhead personnel drive.
Okay.
Managers, owners, that type of thing. And the crew truck, I'm going to build that into the price of the crew for the day.
Mm-hmm.
On that. Now, let's take a landscape installation project. I would come up with a cost of the labor for the day, the labor hours, labor burden, the crew truck, and overhead for that, net profit, that type of thing. And so materials I treat separately and with a separate markup. So on that overhead number, I only want to include the actual vehicles that the overhead staff are using on that. Everything else I want to put in the field on that. So if I have that landscape installation job, and let's say for the day the crew is going to be $2,100, $700 per man per day. Okay, then I'm going to take my materials, and then I'm going to have all my specialty equipment, mini X's, skid steers, whatever, and I'm going to put those on separate with a cost per hour for those. Now, for materials, usually I'm going to charge retail price for materials when it's all said and done. For the homeowner is used to paying retail. The marketplace is going to reinforce that for me on there. And so I'm going to charge retail prices for materials, minimum. Equipment for a residential client, I'm going to try specialty equipment, mini X's, skid steers and stuff. I might try to charge rental rates for those if I can get away with it as well. It's something to think about. A lot of people don't seem to understand, especially subs, but if you're working for the homeowner, you're going to charge the homeowner a retail price for your work on that. And now, if you're doing landscape installation work for a builder, general contractor, or so forth, now you're going to charge them a wholesale price, which allows them to tack on extra profit and charge a retail price to the end user. Does that make sense?
Yep.
And so I think that just makes a lot of sense. And if you're working with subcontractors, basically, if a subcontractor is working for the homeowner, they should charge the homeowner a retail price. If they're working for you as a contractor, you're subbing the work out to them, they should give you a discounted price, wholesale price, so you can tack on profit and whatever and pass it on to the homeowner on there. Unfortunately, a lot of subs, they don't understand that. They go, well, why should I, charge, you, Mike, less than I'm charging the homeowner? Well, think about this, because you're doing the marketing for the sub. Let's say it's an irrigation sub. They don't have a salesperson going out every night trying to sell this thing and pay them 8 to 10% for doing so. Okay, you're doing that for them. Plus, the other thing is you're giving them multiple jobs, not just one job. So you deserve a discount. Same thing when you go to buy materials, is that if you go to a nursery and you buy either hardscape materials or plant materials, since you're a contractor, you get a discount. You get a re-wholesale price. Okay. And then that allows you to mark up the price, pass it on to your residential customer, and charge them a retail price. If the homeowner comes in and buys the same material, same tree or whatever it is, they're going to be charged retail price, and they should be on that, because they're only going to give the nursery, maybe one job, and it's just what it is. And so, but that's why you deserve a discount working with a nursery. The same thing as how that discount applies for whoever you're doing work with, and also subs out there on that. But it's very confusing as to a lot of people just don't understand this.
Okay, Jim, last question, I promise here, but I've got plenty more questions for round two if you would ever want to come back on the show for sure. But the only thing that I can kind of wrap my head around with not allocating equipment to overhead for a business owner would be the cash flow perspective. If they're financing a piece of equipment and they have, say, $1,000 a month, and they end up not even using that piece of equipment during that month of financing, and so it's not priced on any project, I would say that would be the only kind of pushback to that. Is that something that you would say to a contractor then, hey, why would you own that piece of equipment? Why not just rent it if you're going to go a whole month without using that and still have that financing payment of $1,000 for that month?
Yeah, and this is where that I think you bring up a good question. And the problem with a lot of contractors is they get around to iron and their palms start sweating. I mean, they want to own this stuff. And so the dilemma is, or the sort of the standard is, when I tell people, it says you want to essentially be using a piece of equipment maybe half the time, or at least about a third of the time, to justify owning it. In other words, you need to generate enough cost off of that piece of equipment you're charging your customers to justify it. And if you're not, if you're going to, basically, it's going to be a lot cheaper for you to rent it. By all means, rent it on here. People want to buy all this iron, and they just can't afford it because they're not using it enough. They're going to have to charge it to their customers. And so what happens is they become iron rich and cash poor. And so you got to keep that balancing act, and you got to make sure that to me, it's like having 3 or 4 guys sitting in the back room playing cards and they're on payroll. And you're going like, well, I might need them someday. Okay, great. But they need to be billable. I mean, we need to eliminate those types of costs out there. Otherwise, we're going to really kill our bottom line on here. We got to make profits. So this is where, when it comes to equipment, try to be using it at least a third of the time. And, say, okay, basically, if I'd rent this equipment, would what I'm charging clients cover that? And maybe you are better off renting it. Now, there may be specialty equipment that you have to have. That's different. But like I said, people, they get around this iron, and they go to the Equip Expo in Louisville, Kentucky in October, and these guys are just shaking, and they're looking at all this equipment. It's like, man, they need to go to some sort of recovery or AA meeting for equipment. And I mean, again, I got my own problems with things I like to buy, but but anyway, but we've got to be careful about that and measure those things and make sure they're justifying their existence.
We want to take a break from today's episode to thank our sponsor, Knowledge Tree Consulting. They are efficiency consultants in the industry with 35 plus years of industry experience building Oriole landscaping in Toronto, which they are completely hands off at this point. George and Peter have been on the podcast before, and George, on multiple occasions now, I've personally leaned on him to help with the How to Hardscape headquarters software and how we can maximize the efficiency of user experience. And I know the guys at DTE Landscaping, Chuck and Jeffrey, who we've also had on the show multiple times, have hired them on in the past. Check out their consulting services, peer groups, and events that are coming up on their website, knowledgetreeconsulting.com, or check them out on Instagram at joinktc. Now back to our episode.
This is my follow-up episode to Jim Huston and my thought process on overhead recovery systems, as well as what we use with the How to Hardscape headquarters software.
Back in 2019, I started the How to Hardscape podcast, and I actually started this back in the beginning of 2019 with a website. And with that, I tried to leverage my skills as a content writer and knowing a little bit about SEO to get a head start with articles. And when I was trying to decide which articles to write, I went to a conference that was talking about a specific project, and a guest speaker came up to talk about how they estimate their projects, and they put up their whole Excel file worksheet on a projector and talked about a little bit about how they price certain projects a different way and everything like that. And at that point, I saw almost everybody in the room filled with contractors take out their phones and start to take pictures of this Excel document with the pricing. And it hit me that, you know what? The best way that I could possibly bring value to the How to Hardscape website as well as the podcast would be to talk about pricing. And it's something that if I am good at anything beyond being in the field, it is definitely understanding and knowing pricing and overhead recovery systems and being able to come about a roundabout number that is going to not only recover your overhead, recover your material costs, recover your labor, but also to ensure that you're making a profit at the end of the day on this. And that is where I developed the budget and estimate spreadsheet. And the way that spreadsheet worked was you just inputted your overhead expenses for the year, or it calculated them for the year for you. You inputted your material catalog. You could choose on drop downs which materials you add to a project, and your labor costs as well worked the same way. And then it came to a point where you could add certain percentages markups on everything there. So we had an amazing response to this spreadsheet over the 2-3 years that it was on the market. And I tried to develop that spreadsheet over the years, and it got to a point where the next step in the process of upgrading the spreadsheet was to implement time tracking, timesheets for employees, but it just wasn't a viable option to have that in an Excel file or in a spreadsheet. So we developed the How to Hardscape headquarters to help us with this further development. So now you can't get the spreadsheet, but you can definitely sign up for the software. And what the software is going to help you to do is budgeting, estimating from that budgeting, and be able to keep track of numerous things within your business. There's a lot of things that we're working on to be able to do that and provide reports on your budgeting and to be able to send you notifications on when you should revisit your budget. But we've also got other features like time tracking, timesheets, scheduling, rolling out, and these features are going to continue to compound upon themselves. And the best time to sign up for the software is before new features are rolled out and the price increases, because when you sign up, you're locked in on your pricing. So essentially you're getting in before all of the features that we will eventually have are coming out, but we'll continuously continue to improve this software anyways. But as more features do get released, the price will increase, and when you sign up, you're locking in your pricing on that. But with that being said, I, over the years, have digested and spoken to a lot of experts in the field of pricing and overhead recovery systems, which had me thinking about how I was going to incorporate these overhead recovery systems into this software to ensure that we're covering our bases with everybody. And the one thing that had me scratching my head the most was the reliance on MORS, or the multiple overhead recovery system, or really the single overhead recovery system what Jim Huston calls the dual overhead recovery system, and other overhead recovery systems such as factoring, which was what Jim Huston calls it, which is essentially multiplying your materials by a certain amount, and that's what you're going to be charging. Or things like square footage pricing would also fall under that factoring category, which we never recommend to do. With any overhead recovery systems, there are going to be pros and cons to them. And as Jeffrey Scott talked about a few episodes ago, is that you can choose an overhead recovery system that works best for you. The importance of choosing an overhead recovery system and sticking to it is knowing why you're choosing that overhead recovery system. So I thought I would take this episode to talk about my own business, as well as I think most businesses out there in the green industry, and why I use the overhead recovery system that I use in my business. And I also promote through the How to Hardscape headquarters software. Perhaps it's a best place to start with the factoring or using square footage pricing. The obvious pro to this is that you're going to get your estimates out faster. And in this economy where we are at, it does seem that the sooner you can get out your estimates, the sooner that you can get that to a client, the better. And this would be the easiest way to go about that. The downside to this is not necessarily knowing exactly what you are charging for. So in this case, you would be taking just a square foot price or your materials and just adding a multiple on top of it. So your materials times 3 or times 4, or the square footage times a certain square footage rate. And by doing this, you're not knowing what you're charging for your labor, which is a crucial part of estimating and getting better in your estimating, is knowing what you're charging for materials, for labor, for overhead recovery, and for your profit and what the profit is, so that you can go back at the end of the project and be able to job cost these things, be able to see where you went right in the estimate, where you went wrong in the estimate, and to be able to update your overhead recovery system, or be able to update your estimating, to be able to ensure that the next project that you do, you're quoting and estimating a little bit better for that. Because if you get carried away with this factoring method, you can definitely get lost and not know what you're making on projects. And perhaps your labor was a little bit off on that previous project, but you wouldn't necessarily know that with factoring, because you're not breaking down these different areas and being able to compare them to what actually happens in the field. So with factoring, what you are doing is the only thing that you're calculating correctly is your materials, and then you're adding a multiple on top of that. Or even worse is adding a square foot pricing to your projects, and you're not necessarily taking into factor the different aspects of every single job, whether that's the access, whether it is a long distance from the curb to the backyard where you're excavating, or all these different variances between projects that we are quoting and estimating. Really, the only way to use factoring is for markups or your sales tax at the end of quoting your projects. So in terms of factoring, we do not recommend this. It is the fastest way to get estimates out the door. It's also the fastest way to not know what's going on in your business between the office and estimating projects, and then into the field and being able to complete projects and go back and see what went right, what went wrong, and to update your estimating process. Single overhead recovery system works very similar to this, where you come up with a percentage that you're marking up everything in terms of those direct costs to recover your overhead. And much like being able to factor in your materials times a multiple, this just doesn't take into factor the variances between materials, labor, and being able to put a multiple on top of both of them just doesn't sit well with knowing that materials don't require a lot of management over versus labor, which does require a lot of oversight and logistics and planning that goes into that, as well as inefficiencies with labor and being able to mark up labor separately from what you would mark up materials. And then even within materials, there's going to be different markups between, say, plant products that you need to warranty that could die, and you want to add a higher markup to those versus hardscape materials, which won't die. And the only thing that you need to be able to figure out logistically is how you're going to get them to the job site and being able to order them. And there's very few that are, hopefully very few that are cracked when they do show up to the job site, which requires you to replace those or to be able to order new ones. So there's definitely different markups that I recommend between just materials alone, but also the difference in markups between labor and materials. So this is why the single overhead recovery system I would not recommend for that. Kind of similar to factoring and being able to provide a multiple that you would mark up your direct costs being materials and labor for that. Which brings me to multiple overhead recovery system, because this would be seen as the next step beyond single overhead recovery system to be able to assign certain percentages to these various direct costs of a job to be able to recover your overhead. And Jim Huston in the last episode talked about how their percentages for each of these different categories being materials, labor, subcontractors, the percentages assigned to them are just random. Something like 5%, 10%, 25%, or whatever that might be, to be able to carry those costs and mark up those costs over to your overhead recovery. So, for example, materials might get a 10% markup, and that 10% markup carries over to recover a little bit of your overhead. And labor might get a 25% markup, and that 25% markup carries over to recover your overhead. And Jim Huston's argument is that these percentages are just pulled out of mid-air. And if you have the chance and opportunity, there is a book by Jim Huston on the multiple overhead recovery system analysis, as well as I believe these other overhead recovery systems. But also, Charles Vanderkooy also had a book on pricing hardscape projects or interlocking concrete pavement or whatever hardscape projects that he talks about in that book. And it was an excellent book when I first bought it to be able to read through. And I know that Jim Huston used to work for Charles Vanderkooy as well, so he was very familiar with that system. But assigning random percentages without knowing what those percentages mean to the rest of your business and whether or not you're recovering your overhead just did not sit well, obviously, with Jim Huston, which is why he developed his book on the analysis of Moore's. I know that with some softwares that promote multiple overhead recovery systems, do create percentages based on your budget to be able to recover overhead within your budget. Now, this is where I find it difficult, and especially me in my business find it difficult to lean on this system to be able to provide me with my percentages that I'm going to mark up my materials, mark up my labor, and mark up what my subcontractors for this to be able to recover my overhead. And this is because my business, no two projects are the same. And I would say that I would assume most of our businesses in this industry, no two projects are the same, but especially in my business, we started as a hardscape maintenance business or a lift and relay business, and we still hold on to a little bit of that business. And even though we've kind of transitioned to more of a design build business, we still hold on to that lift and relay. So just comparing those two different types of projects, a lift and relay business will require a little bit more labor, but much less materials, as opposed to a design build business will require a lot more materials and a little bit less labor than that of a lift and relay. Talking about percentages and not really the hours put into that, though. And that's because a lift and relay, you're actually physically having to lift up those pavers, clean them, palletize them, and then eventually put them back down. Whereas a design build business, if there's anything existing there, you're just tearing it out, disposing of it, and that's usually machine work, which is why labor is a little bit less, not in terms of hours, but in terms of percentages at that stage of the process. And then materials are much less for lift and relay because you're reusing those materials, whereas a design build, you are purchasing and installing brand new materials for this. So if I was to use the multiple overhead recovery system, I would need to create a budget that includes the projected amount of materials in a dollar amount that I would be using for the season or for a quarter or for whatever I'm budgeting for. Now, the problem with that is in my business, we're typically booking out 2 to 3 months. And especially when the economy is not exactly in the spot that it's been for the past few years, we're down to about 1-2 months booking out. And we cannot project what types of projects are going to be coming in and what types of projects that we are going to be taking on. When the economy is really good, and especially for the past few years, we could project that a little bit better for our business because we had a large pipeline and we could pick and choose what types of projects we wanted to take on for this. However, that's not going to be always the case. So if we need to set a material cost that we are going to incur for that quarter, for that season, whatever it might be, I can't sit down and accurately decide what my materials are going to be for that season. I could say that we are going to do 100% design build and then in the coming months sign up a bunch of lift and relays, and then my material budget is way out of whack because I've budgeted for a bunch of materials to be showing up there, and I'm counting on my multiple overhead recovery system percentage to be able to recover some of those materials in my project to then cover my overhead. And being able to do that just does not recoup the overhead that I would want to, because if I budgeted $100,000 worth of materials in the first quarter or whatever it might be in my business, and I'm expecting a markup percentage on that $100,000 to help me recover my overhead, but then I sign up a bunch of lift and relays, which is more like $1,000 worth of materials for that same time period, and I'm carrying over that markup percentage to those $1,000 of materials versus the $100,000, I'm losing out on a lot of money to recover my overhead. Now, this is a very specific example for this and a more drastic example of, say, a design build business that also does lift and relay. But even within a lot of businesses that I have talked to or I have seen, you may do a big design build project and then go over and do a drainage project, the next project. And even those materials are going to be very, very different. And then even if you only do design build projects, one project might require a lot more labor because you are having to do a project with tight access, or do a project where the run from the curb to the backyard is twice as long as the previous project that you did. So there's more labor that goes into that as opposed to materials where the percentages are different, but the material costs would be the same. This is where the multiple overhead recovery system, I think, falls flat for me, and trying to wrap my head around how I can use these percentages to recover my overhead. Now, the positive thing or the pro from this maybe that I could wrap my head around, besides the con being that it just complicates things. It requires me to budget the exact dollar amount of my materials for this, and to somehow also budget the amount of subcontractor dollar amount that I'm going to be using, because it's going to use those percentages to recover my overhead. The pro to this would be if I live in a state where the sales tax is different from labor to materials, and I can assign my overhead through materials, labor, subcontractors, and whatever else I might want to assign that overhead to. That would help me bring down the amount of sales tax that I'll be charging. Say if I only charge sales tax on labor, I can assign some of that overhead recovery to materials as opposed to just assigning it to labor, which we'll talk about the labor rate overhead recovery system next. But that is the only way, the only positive that I can wrap my head around this multiple overhead recovery system really helping, is if I want to be super competitive in the market and I can charge a smaller sales tax for the project as a whole by spreading that overhead recovery through my materials, through my labor, and through my subcontractors, I can help to reduce that total estimate very slightly for this, as opposed to the labor overhead recovery, where it is all my overhead recovery is just being assigned to labor. Now, really, when you get into multiple overhead recovery system and other overhead recovery systems like it, like single overhead recovery, dual overhead recovery, this is more so just a more complicated way to go about factoring, in my opinion. And I know that Jim Huston also talked about this as well, that it is just a more complicated system to have to wrap your brain around, to be able to just factor at the end of it, because you're just factoring, you're just adding a multiple on top of labor, materials, and subcontractors. And as Jim Huston said, these percentages that you're adding markups to are just pulled out of mid-air, but I do know some softwares help you to refine those percentage markups, but they're still based on a budgeted amount that you may fall short on or may go over on, such as materials, because every single project is not going to be the same. Every project is not going to have the same percentage of materials for your project. So how do I go about creating an estimate, or what overhead recovery system do I use? And I've kind of pulled different various systems and also added on top of them to be able to come about how I use my software, and before that the spreadsheet, to be able to charge an accurate amount for my overhead. And it's a very simple system. It's more so like a modified labor rate or labor overhead recovery system for this. And the best thing about this is that it's extremely simple, and it is something that anybody can pick up right away. You don't have to get into budgeting the perfect dollar amount for materials, and you don't need to get into knowing what these different percentages are that you're marking up on labor, materials, subcontractor, whatnot. This is just the most simple version of recovering your overhead that I've come across, as well as the most accurate without adding more complicated tasks on top of it. And what we do is we set the amount of hours that we're going to work in the season. So that would be weeks of the year multiplied by days of the week that you work, multiplied by hours of the day that you work, to give you your total hours that you have to recoup your overhead. Now, you could spread this out further by multiplying it by the number of employees that you have in your business that are in the field producing that labor. For example, if in my season I have 1,600 hours to recoup my overhead, I could multiply that by the number of employees that are in the field producing that labor. 1,600 times 5 employees, or whatever that might look like. But you can also do it by crew. And I tend to fall more to the crew multiple for this. And this is because employees change more than crews change in most businesses. So you might lose an employee one week, gain 2 employees the next week, lose another one in a month, whatever that might look like in your business, and with the difficulty of holding labor. But for the most part, your crews are not going to change. So if you do lose 1 employee, you likely still will have 2 crews, or 1 crew, or whatever number of crews that you may have. So there's a fork there that you can go down with this labor overhead recovery system to decide if you're going to recoup your overhead by crew, or if you're going to recoup your overhead by employee. I also like the crew method because crew recovery is going to be more consistent than the employee labor overhead recovery, because each laborer or each field person that's producing labor is going to have different efficiencies to go about them. So not every crew member is going to be as efficient as one another. However, most crews, when you compare crew A to crew B, will be about as efficient as one another in recovering that overhead, in producing those labor hours to complete a project. So just to break that down, employee A, B, C, employee A may be the foreman, who is much more efficient and effective at producing labor and completing a project than employee B. And employee C may be a completely new hire that requires a lot of work to train up. However, crew A, B, and C will likely have a mesh or a mold of those 3 employees throughout. And so when I'm comparing crew A to crew B to crew C, they're likely much more consistent at the amount of labor that they're producing for that project. Whereas if I go into each crew, employee A, B, and C will have a much wider efficiency for each of them in the labor that they are producing in the field. Now, once I've got the amount of hours that I have to recoup my overhead, I need to decide on the amount of overhead that I have. And that gets into adding in everything that comes out of your business, everything that your business is spending and the money is going out. That is where you need to factor in all of this overhead. And personally, I incorporate equipment into overhead. The reason why you would not do that was discussed with Jim Huston, but I still kind of differ on this for being able to budget my overhead. And the reason why I kind of differ on this is because if you separate equipment from overhead, and let's say you have a piece of equipment that you use once a week, but you have a finance amount that you need to make payments each month for this piece of equipment. One, if you are using the method of separating equipment from overhead expenses, you need to assign that a piece of equipment to the project for the time that you need to use that piece of equipment on that specific project. This adds a much more complicated step in the process that is going to be a little bit more difficult, especially if you're handing the system off to an estimator to be able to do this for you. This adds another step in the process that could be overlooked, and then you're not assigning that piece of equipment to the project, and then this throws off your numbers for that estimate for that project. Whereas if you incorporate equipment into your overhead, you're recouping that cost of that equipment on every single project that you are estimating. And when it comes down to financing, like I was saying, monthly payments for that piece of equipment, if you only use that piece of equipment once a week, and you need to assign that a piece of equipment to that project, you're not making back the full monthly payment for that piece of equipment. Or even worse, if you're inconsistent with the amount of times that you're using that piece of equipment, so maybe 1 month you don't use that piece of equipment, but the next month you use that piece of equipment 5 times or a handful of times, you're just being too inconsistent with charging for that piece of equipment and being able to make those monthly payments on that piece of equipment. The argument against that would be that you should only be purchasing pieces of equipment in your business that you're using a set amount of time and be renting the remainder amount of time for that. And when renting, that becomes a cost of sale item, much like materials would. The way I look at it is when you're calculating the cost of that piece of equipment and you're only using it once a month, you're going to get more years of use out of it. So you're going to spread that piece of equipment out over a larger time period, which is going to bring down your costs when you're estimating for that piece of equipment. For example, a $100,000 piece of equipment used every single day is going to have less years of use out of it than that same piece of equipment at $100,000 where you're only using it once a month. So your years of use increases, which brings down that total cost for that equipment. Because the calculation for equipment is that purchase price or cost of replacement minus the resale value at the end of its expected life, and then divided by the years of use of that piece of equipment. So if we increase the years of use of that equipment, that means the total cost of that equipment comes down when we're actually incorporating it into our overhead. That's the way that I like to go about this. I don't like to have to assign equipment to specific projects to recoup that cost. I want to know that I'm recouping that cost. But this is also a great formula to help you understand whether or not you should purchase that piece of equipment or just rent. Because if you extend those years of use out of a longer period of time, and you're able to calculate the cost of replacement or what you paid for that piece of equipment minus the projected resale value at the end of those years of use. And if that amount per year is way far off of your finance amount for that piece of equipment, you may want to look at renting it. For example, just easy numbers here, $100,000 piece of equipment, and let's say it's going to have a resale value of nothing. You're going to use it all the way to the end of its life, and you're only going to use it once a month. You might get 10 years of use out of that, just easy numbers, to get $10,000 a year that you're going to recoup for that piece of equipment for your overhead. If your finance amount is much greater than $10,000 over those 10 years. For example, your finance is 5 years and you didn't put any down payment on that. So that's $20,000 per year. That's double what you're recouping for that overhead of that $10,000 per year. You may want to then decide to look at renting that piece of equipment, or using that equipment more, so quoting jobs that's going to put that piece of equipment to work more, to then reduce the years of use you're going to get out of it down to maybe 5, which is then that finance amount of 5, which brings it down to $20,000 and recouping your complete finance amount of $20,000 for that year. I hope that made sense to you. If it not, reach out to me at How to Hardscape, or shoot me a message wherever to talk about that a little bit further there. But that's how I go about understanding whether or not I'm going to rent versus purchase a piece of equipment. And this is why I incorporate equipment as overhead expenses, to ensure I'm recouping everything that I need to pay for that piece of equipment on every single project. Furthermore, if you have a large piece of equipment that only gets used rarely in your business, you may be looking at a whole completely different division rather than, say, a hardscape design build division. You may be looking at like an excavation division in your business. So you maybe, when you quote an excavation specific project, you might look at separating that from your design build project or division for that. And then what we look at with this is, when we quote a project, we take that and divide it by the number of hours that we have in a season. So for example, we said 1,600 hours in the season to recoup our costs. If our project is going to take 160 hours, that's 10% of our season. So then we would multiply our overhead expenses by 10%, or 0.10. And if our overhead expenses are $100,000 for the year, then multiplied by 10%, that would be $10,000 that we would assign to that project as our overhead. We would assign that to our labor. And that's how we recover our overhead accurately. This is a completely simple process to be able to say, this is the amount of time as a percentage of our season that we're going to be on this project for. So we need to recoup that same percentage of our overhead expenses for the season. Where this can go wrong is if you do not accurately budget your overhead expenses. Additionally, where this could go wrong is if your overhead expenses are too high for the market that you're in. But that could be said for any overhead recovery system. For example, if you go out and purchase way more skid steers than you need for your business, or brand new trucks and dump trucks all around, and you have way too much equipment that your business actually uses, you may be overpriced for your market. Now, that's a completely different topic that we can get into in the future, cost-based pricing versus market-based pricing, because I've talked to quite a few people on both sides of that argument, but it's always good to calculate your cost-based pricing and compare it to your market, in my opinion. Because if your market is much lower than what you're priced, you're either overestimating what your overhead costs are, or you've just purchased way too many things for your business, thus overpricing you, or your market could be just way underpriced and you may be looking at getting into a different market, or creating brand around your business that has people wanting to hire you and thus making them want to pay more for your services. Brand is another topic that we can get into as well, and how to foster that branding in your business to be able to get those clients that you want in your business, and to be able to service those clients that you want and allow you to charge what you want to be worth as a business. And just to go quickly down this rabbit hole, besides overhead recovery, which we've been talking about, With this pricing, you would then add in your labor, which is a simple calculation of the amount of hours for that project multiplied by whoever's on that project. Where this goes wrong is if you are an owner and you are not incorporating your salary into this calculation, you're doing it wrong. The profit from the business is not your owner's salary. Your owner's salary is on top of that. So you do need to calculate what your salary is worth. When I do this, I look at every single function that I do in my business. I add up the amount of hours that I do for each of those functions. For example, salesperson, designer, foreman, whatever. And I then look at my market and what would it cost me to have to go out and outsource these things or to hire somebody to do those, and I add up all of that salary into my salary. So for example, I'm not a 100% 40 hours a week salesperson in my business. Maybe I'm 10 hours a week as a salesperson. I would look at that as a percentage of what a salesperson would cost me and add that salary into my salary to get a good market driven salary for what I'm recouping in my business. Salary would look the exact same way as overhead, where I'm taking a percentage of what that project is, say 10%, 160 hours over 1,600 hours that I have recouped my salary, and just take 10% of what my salary is for that project. In addition to that and any hourly labor that you have, you also want to add in a labor burden percentage on top of that. This is for things that you may not know, or add in bonuses or things that you do know, like payroll taxes on top of that, to ensure that you're adding in all of these things that you are making back in your business. Additionally, what we do is we add in an efficiency factor. So for example, we want to take into factor the drive time to the job site and then drive back to the shop at the end of the day for employees to punch out. Those are wasted hours on every single project that you need to add a markup percentage for your labor hours for that. Breaks and lunch, if they're paid for, you want to be able to add in those dead hours for that as well. We do still add a material markup to our materials, and what we do is we base that on the amount of callbacks that we have for those specific materials, not for our workmanship, but say a material cracks over the winter, we go back and we replace that. So how many projects are we needing to do that on? And we work out a markup percentage for each of those materials. For example, planting material, even though we don't do planting material in my business, that would have a higher markup because plants die, and for that warranty, you'd have to go back and have to replace them. So we figure out a markup percentage based on that calculation for this, because this markup percentage for materials is not recouping our overhead. We've already done that with this overhead recovery system. What this markup percentage is incorporating is our warranty on those materials and having to go back and replace any of those broken, dead materials. So then with that, in adding in our material costs, and that also incorporates subcontractors and renting and those materials into this cost of sale item, we then have our cost of sale or our materials. We then have our labor, and then we then have our overhead recovery. And with all of this, we then need to factor in our profit percentage, our net profit percentage. So this is after everything has been paid for. What is the business making, which is separate from our owner salary? We add in that profit percentage. I like to think about it this way. I like to, in the history of the stock market, you could average an 8% in a broad range index fund if you invested into it. And that takes no time of yourself other than having capital. So all that costs you is capital to be able to invest into the stock market. 8% is just a round number to go about it. I've heard higher, but just as a simple number, 8%, as well as a conservative number, 8%. No time required on your part to invest that, just capital. Your business requires capital and your time. You should be making much more than 8%. 10% is the floor for me for net profit percentage. And if you're making 15 to 20%, that's much better. 20%, you're doing really, really well for your business.
And profit is a margin, not a markup. So it is not taking a percentage like 10% and marking up your total amount by 1.1, but it is taking the inverse of that and dividing. So if our profit percentage is 10%, that would be the inverse of that would be 0.9. And then we're dividing our total by 0.9. And that's what gives us our margin as opposed to markup. We want to take a break from today's episode to thank our sponsor, Cycle CPA. It's crucial to review your financial statements on a monthly basis so you can diagnose areas for improving your business's financial health early before they become significant issues. Too many contractors wait until the end of the year to review their financials as they file taxes, when it's often too late to take action to change the outcome. Cycle CPA not only handles bookkeeping and taxes, but they also ensure that you're armed with financial data on a monthly basis to make key business decisions. They offer benchmarking, cash flow forecasting, and assistance in developing targets for financial metrics. With their team of accountants specialized in the hardscape and landscape industry, they currently work with hundreds of companies in this field. Visit cyclecpa.com, and for $200 off, mention the How to Hardscape podcast. Now back to our episode. And this is Weston Zimmerman of Synced Up discussing overhead recovery systems with me. But let's get into budgeting, and the reason why actually we wanted to have this discussion, because earlier this year I had a guest on the How to Hardscape podcast, Jim Huston, who talked about multiple overhead recovery system and his viewpoints on it and what he would do differently if he was budgeting and trying to recover his overhead. And I tend to agree with a lot of what he said. Some things that he says I think are maybe outdated ways of doing multiple overhead recovery system. Maybe it's been developed. But I want to know your thoughts, because I know that you have your own thoughts on budgeting and recovering that overhead. So I'm just going to give this to you and let you kind of start the conversation. What are your thoughts on the correct way? I'll set you up for a spike on that. The correct way to recover your overhead, or what does that look like for a business, a landscape business?
I mean, this sounds a little cliche, but the correct way is whatever way you can use and use consistently. And so to that point, like I said, told you off the podcast, every system, budgeting is pure math. And in math, there's variables, there's inputs, and there's outputs, right? And any system, you can put dirty inputs, like pollute the math by putting bad inputs or abusing the math, the system. So any system you can break. And so to Jim Huston's point, I remember, I haven't listened to it. Whenever it came out, it's when I listened to it. So that was a couple months ago. But what he was really railing on was the arbitrary 10% or 20% overhead recovery on materials. Like, where'd that number come from? It just pulled it out of thin air. Yeah. And I'll get into that later. But like, the point is you can abuse any system. Yes. And you can. So it comes down to understanding and grasping the system that you are using to the degree that you are aware of the ways to abuse it or make it tell you something that's not true, and avoid them. Right. And so if you do that, then I don't really care what system or what method you use. Right. It's more of, because it's like no system is infallible. Right. They're all equally, they all have pros. Like it's like, I've said this earlier on some of our product meetings internally. All you're doing is moving the complexity. Yes. So, okay, so fine, let's not do overhead recovery on materials then, fine. Well, what he was proposing as the solution is like, all you did is move the complexity over there. Yeah. You know, and so, yes, you solved it, you couldn't break it over here, but now you can break it over here. Right. You know, and so those are some of my thoughts overall on how budgeting should work and what's the best system.
So don't mind me, I'm going to take notes just because I forget questions that I have in my head to revisit here. But one of the things that I do agree with him on is that labor, we're in a service industry, we're selling labor, and labor has a schedule, amount of hours. Whereas that's where I agree with like a labor rate, recovering overhead through your labor rate based on your schedule works really well. Yes. Whereas multiple overhead recovery system has you recover it through materials, and materials can be very different. Yep. It's very difficult to budget materials unless you're a well-oiled machine and you're doing the same design build project from project to project, right? That's where I have a problem with multiple overhead recovery system. I'd love to know like your thoughts on that.
So I'm not married to Moores in any way.
Right.
And so I actually agree very much with Jim Huston's like reasoning behind why you should do it on labor, is because labor represents a finite span of time.
Yes.
And so there's two thoughts I have on this. Labor is very effective thing to anchor your overhead recovery to, because you have a finite span of time, like a year, to recover that year's worth of overhead.
Right.
And you want to recover that in a year, not 11 months, not 12, not 13 months. You know, recover it in a year.
Yes.
I mean, if you do it in 11 months, great, you know, and so to that point, labor represents a span of time. Like if you have 8,000 man hours in your budget, well, that means 4 guys times 2,000 hours. You know, it represents a span of time. Materials has no anchor in any way to that.
Right.
Right. So I actually agree with that line of thinking. The other thing I would say is you should anchor your overhead recovery to whichever is your most consistent expense.
Yeah.
Most times that's labor, but not always.
True.
You know, some people have like kind of they'll use a lot of subs, or maybe, you know, who knows, insert the variable. Like, but like I actually do tend to prefer recovering most, if not all, of my overhead on labor. That's my default go-to. Unless your business model has a logical case for doing something other than that.
Right.
Like I'm not a fan of like what I know a lot of people do in Moores is like 10% on materials, 10% on subs, 10% on equipment, and the rest on labor. I'm not a fan of that really, because the way I kind of view equipment, it is an overhead expense.
Yes, I do too.
And so you're recovering overhead on top of overhead.
Yeah.
It's kind of weird, you know? Subs I don't like, unless subs, again, trumps labor in terms of it's your most consistent expense. So if your business model is all subs, well then yes. I had that conversation today with somebody that just signed up with Synced Up, that they're a total sub model. And so it doesn't work to recover his overhead on labor on man hours.
Yes.
So yes, okay. So to kind of practice what I preach here, my preferences are X, Y, Z. You know, recovering it on labor, not so much on anything else. Definitely not on equipment. But at the end of the day, what's your business model? Let's anchor your overhead recovery to the most consistent expense you have, because we don't want to anchor it to the thing that can swing. Like materials can swing, because if you anchor it to the thing that can swing, like maybe one year you do $200,000 worth of materials, and next it's double.
Yep.
But it was the same span of time, a year. Well then, most likely on the year you did $200,000 worth of materials, you didn't recover enough of overhead. On the year you did 400, you recovered too much, or priced yourself higher than you would have needed to, and could have potentially lost work.
Right.
So it all comes, to me, in my way of processing, it all comes back to anchoring it to the most consistent expense, because that makes sure that your overhead recovery is as predictable as possible, and lets you assign the rest of it to whatever value you're producing. Like, you know, it's not like it's priced too high or too low because of overhead recovery.
Yeah, as soon as you like start to peel back the onion, it's amazing like how much we really do agree on when it comes to this. We've talked about a lot of this off the air as well, like things like equipment. I also tie my equipment to overhead. I'd love to know your thoughts on why you see that as well.
Yeah, well, okay, so a couple practical reasons. Again, the way you view equipment expenses, there are pros and cons to every method, and I hear people like preach that the one is better than the other. It's like, fine, but it's not, and because you could be screwing it up. Then what can happen is someone that doesn't understand the dynamics of the numbers, or how the numbers are working, can come into that method and not be aware of the ways to mess it up, and it actually not serve them. It actually screws them up, like the financials. So there's kind of the two common ones are treat my equipment as any other expense and bill for it by the hour, by the day. When I'm bidding a job. The other one is just treat it as an overhead expense, and it gets baked into my overhead recovery, which is what we just did talk about, the overhead recovery. So there is a case to be made for both. So on one hand, the con of putting your equipment in the overhead recovery is, yes, it will jack assuming you're recovering your overhead on labor, it will jack your labor rates up.
Yes.
And in a business where you're doing both reoccurring maintenance and install, what can happen is your mowing price goes up because all that overhead and equipment that you have. And so the solution could be, well, then maybe you should build two budgets, one for maintenance and one for install.
Yeah.
So So those are ways where that's the most common reason people don't want to put equipment in overheads, because it jacks their other services up unless they do multiple budgets.
Right.
And it also does the thing of like, what if I sell a job to Mrs. Jones that pretty much doesn't need any equipment versus one that's really equipment heavy. I want the cost to be weighted.
Yep.
Like if I don't use the equipment, it brings my price down. If I use the equipment a lot, it brings my price up, which is cool. As long as, this is the cons of this method, as long as you don't tweak the numbers in your estimate, because equipment is a significant portion of the price of a job. And what I have seen many times is salespeople be like, man, I really want this job, man. It won't take 5 days with that skid loader. Just take 3.
Yeah.
Just take 3. So they tweak it, and it has a significant impact.
Yes.
But then it takes 5 anyway.
Yep.
Right? And or this other thing that I've seen is like where a contractor is like, well, I didn't put the equipment in the bid, so I'm not going to bring it. Meanwhile, it's taking me longer to do the job. And now I wish I'd had the equipment in the bid, but I'm not going to bring it because I didn't have it in the bid.
Yep.
Now it's taking me longer to do the job, but I'm not going to bring it because I don't want to add that cost.
Right.
Well, you're losing opportunity cost by the fact that it's taking you longer to do the job. You'd almost be better off just bringing the equipment and just doing it. So you have that other billable day to go put to another billable job, even if you didn't have the equipment in your bid originally.
Right.
So that's kind of the billing by the hour, by the day, billing by the unit for equipment is effective as long as you're not susceptible to tweaking the numbers and that you are factoring in depreciation into that hourly rate, because that's a big chunk of it, right?
Definitely.
It's not just fuel and repair and maintenance and operator. You got depreciation. It's a significant chunk of that rate. So on the recovering equipment and overhead, I like it because it's simple. You almost can't screw it up. Meaning, if it's baked into your overhead, however you're bidding the job, it's going to be there. And then you kind of have the mental freedom or license to, if I need the equipment, I can use it because it's baked in. But then the caveat that people often don't like is whether I'm planting a flower with a shovel or I'm digging a ditch with a $80,000 machine, the labor rate's the same. Doesn't matter. So that's what people often don't like about that method.
Yep.
But my argument against that is that equipment is costing you money whether you're planting a flower with a shovel or whether you're actually digging it. If that equipment's sitting back in the parking lot, you still have to pay. The payment's going to be, you're still going to have to pay for it.
Yep.
And it's still depreciating.
Yep.
You have to recover it. It doesn't matter what you're actually doing in that man hour. So my argument is like, just bake it in, recover it, use it when you need it, leverage the equipment to its fullest. Don't get hung up over like, well, I didn't have it in the bid, so I can't use it. And you actually will generate the funds needed to pay for that, depreciate all the expenses you have related to that equipment throughout the year. And it's simple. You don't have to think about it. You don't have the temptation of like, it's not going to take 5 days, it's going to take 3.
Yep.
It's just like bake it in. It's not even on the thing. It's just less moving parts, less ways to mess it up, in my opinion.
I agree.
Yeah.
I agree. I also don't like the extra step of when you're quoting a project, having to figure out, okay, what equipment am I going to bring this project?
Yeah.
As opposed to just having it in your overhead. I also talk to people about creating either a cash flow budget or a comprehensive budget. The cash flow budget being more so, okay, I want to pay for my equipment. I want the financing to be paid for, whether I'm using that equipment or not. Whereas a comprehensive budget is more so, okay, I'm not going to be using this piece of equipment 5 days of the week. I'm going to be using it 2 days of the week, but I'm going to be able to use it for more years because of that. So I'm able to spread that out. So I'm not going to capture my financing monthly, but I'm going to have that equipment for a longer period of time, and my payments spread out over that period of time.
Yeah, so in theory,
or my overhead recovery is spread out over that period of time.
Yes. So if I'm understanding you right, let's imagine you have a $100,000 piece of equipment that you're going to pay off in 3 years.
Yep.
So that payment is $100,000 divided by 3 years, 36 payments.
Yep.
So it's significant.
Yep.
But if you depreciate that equipment out over 10 years because you're planning on keeping it for 10, what's going to happen is you're not recovering the full amount of that payment in a year, which means your cash flow is actually less.
And profit will be less.
Your profit will be impacted.
Yes.
Yeah, exactly. Yeah.
But you're going to have that equipment over a longer period of time.
So then your cash flow is up at the end of that equipment's life. Exactly. Yeah.
As long as you pick one of those and you stick to it, as opposed to, I'm going to do this, and then it just gets confusing. That's the way I like to look at it. Yeah. And I even, if somebody is really careful about their cash flow, I even am fine with saying, fine, put it in as a cash flow, budget for it as cash flow, but then switch to
overhead recovery, or just like over depreciation over the life of the machine, comprehensive, like you said.
Yeah.
Once it's paid off. So you're still, recovering that.
Absolutely.
So
that makes a lot
that's
of
often
sense.
it's like a hybrid, I guess, of the two. Yeah.
Yeah. And I want to get into, I kind of do like a hybrid model in Moore's personally. Now that I like kind of break it down, labor rate, I recover my overhead through labor rate, but I still mark up my materials. So I don't want to make people think like you're just recovering your overhead through your labor rate, and then you're not marking up your materials at all. I still want to mark up my materials to be able to make sure, okay, paver cracks, so we're going to go back and replace that. That's kind of like an unforeseen sort of circumstance.
That markup, do you in your own mind, do you view that as overhead or profit?
I view that as a kind of buffer, and I'm still kind of tweaking that in my own head as to how much that, because right now that markup's not really based on much, right? It's just based on, okay, 1 out of every 20 projects we end up having to go back to for like half a day to fix like a paver that cracked over the winter, or maybe something sunk a little bit. We need to go back because I don't actually have a warranty line item in my overhead at all. So I kind of do it through my materials because it's a more material tied thing. Those warranty callbacks. I'd love to know your opinion on that, and I'm just kind of throwing this at you at the spur of the moment. So
my natural method would have been to do what you just said, which is say, hey, we anticipate X amount of callbacks a year, and maybe on an average they're a half a day or whatever. And so I would view that more as labor, because that callback is much more expensive from a labor standpoint than a material standpoint, even though material is what caused it per se in this month. But it's not always what causes it, right?
Yeah.
So to me, I would have put it more into the unbillable labor, like what I'm budgeting in unbillable labor.
I can see that for sure.
Yeah. That's what I would put in, because usually, not always, usually the material failure, like it's called a material failure rate, is negligible. Like it's unpredictable. It could, most times it's zero, maybe, but I guess it could be significant in a bad whatever.
Yeah.
Maybe.
I'll give you an example.
Yeah.
For example, larger slabs have a larger surface area.
Yep.
So they're more prone to
cracks.
chip.
Yep.
Right. Chips are more prevalent around the edges because the edges are longer.
Yeah.
So you have a higher failure rate for slabs as opposed to smaller pavers.
So you're thinking
same
about
thing with ponds. We talked about this just at Congress. Like my callback rate for ponds right now is not so good. So that's kind of something that I would mark up at a higher rate than. So that's why I kind of do it at the material level. But this is still something that I'm kind of working out in my head, because I can see it being unbillable labor for sure as well.
So the way I'm interpreting what you're saying is it's like a material failure buffer, material failure rate, or it's like I pay for this if everything goes perfect.
Yep.
But there's a certain failure rate or a buffer that you're building in for failure.
Yep.
Or imperfections or whatever on the product. So it's like, I guess if nothing happens, it goes into profit.
Yep.
But if something does happen, you were budgeting for it.
Exactly.
Yeah. No, that makes sense to me. Although I would still argue that the most significant cost in that real life scenario is the unbillable labor.
Absolutely.
Yeah.
Yep. For sure.
And so what I'm more concerned about is your unbillable labor budgeted in accurately or realistically, I should say. And if there was the way I would think about it, I would probably not anchor. That's a good question. Like, I would probably not anchor my covering of material failure off of a percentage of the cost. Although I can see why you would do that.
I'll walk you through my thought process a little bit more while you think about that. Like, for example, if I have a 1,000 square foot patio, 1,000 square foot, the product is $5 a square foot. Let's say that's $5,000, and I add up a markup of 10%. That's like roughly $500. That's going to cover my labor if I'm going to have to go back there and fix a certain percentage of those that might fail. So if my failure rate is, I don't know, 10%, we'll say, that's $500
per.
Yeah. That is 100 square feet that's going to fail. It's not going to be that high, obviously.
Yeah.
But that $500 is going to cover me to have to replace that 100 square feet.
Yeah.
And it's going to cover my labor, right?
I would still, I can see the case for a material failure rate. I would probably split them apart. Like, I would
Unbillable labor.
allocate unbillable labor for the labor part of it.
Okay.
Because it depends what I'm installing too. That it could swing, and it could be a 30-minute fix, could be a 2-day fix.
Yep.
Right. So I would put the labor where the labor is and put the material where the material is.
Okay.
Now, obviously, me buying new material, if it's not covered by warranty or whatever, but I'm still going to, of good faith, cover it or not bill the client for it.
Yep.
You know, then that would be a material failure rate angle or part of the budget. That's how. Just off the cuff here, that's
Yes.
kind of how my brain would dissect that.
So then getting into recovering your overhead through labor rate, do you tell people to mark up the materials at all?
Yes,
And
but
if so, why?
Yes, so the way we think about it is like, okay, cost is what you pay for the product. You know, if you pay $10 a square foot, you know, that's your cost.
Yep.
Overhead recovery is the second component.
Okay.
Then net profit is the third component.
Yep.
So estimating is cost plus overhead recovery plus net profit.
Yep.
And so in materials, if you're not recovering any overhead on materials, all you have left is the cost plus net profit.
Yes.
So if you have a 10, 20, whatever percent net profit markup, it's like if I pay $10 for the cost of the material, I still add 10, 20% on top of that for my profit. So everything, I don't care what I sell, everything gets a net profit markup. It's really the only variable is what gets an overhead markup put in between the cost and profit.
Right.
Yeah.
Right. Okay. You did mention earlier abusing different systems. Multiple overhead recovery system. What's like an example that comes to mind that somebody could abuse it? What does that look like in like the real world? Is that just kind of
Yes.
getting carried away with your numbers and different markups that you're adding together?
Well, I'm trying to think if I can think of a way to abuse multiple overhead recovery specifically, as opposed to any budget.
Any kind of recovery system. I
Okay,
guess.
so the biggest way I see it being, I'll just rattle off a couple.
Yep.
One is if your overhead recovery is tied to labor, which 95% of the time it is, right? I sometimes say, like, you know, budget for worst case scenario, budget for worst case scenario. If you think you want to buy that equipment, or if you think that truck's going to break down, you need to replace it this year, put it in, right? If you wish you could hire an office admin, but you don't think you can afford it yet, put it in. Like budget for worst case scenario. And sometimes I've seen this happen where people are like, okay, you know, I got it, worst case scenario, whatever I think might happen, that's what I'm going to put in my budget. Well, then they'll go in and put field labor employees that they think they might hire next year. And what happens is when you add an employee that you don't yet have into your budget, it now throws man hours into your budget that don't yet exist, meaning nobody's actually producing those billable man hours.
Yeah.
So for instance, a practical example, I'm a 4-man company, but I'm thinking next summer or this summer I'm gonna add 2 more people. So I throw them in right now. Well, guess what that does? It throws, let's just say they're 2,000 hours a year, full-time employees.
Yeah.
So that throws an additional 4,000 man hours into my budget. Now my overhead, let's say I have a $200,000 worth of overhead expenses. Now it's being divided by 4,000 additional man hours that nobody owns yet.
Yep.
So it's lowering my overhead recovery per man hour, but I'm sending bids out today.
Right.
And so for that example, what I recommend to fix that is, like, don't add field labor employees until you cut their first payroll check.
Got it.
That's when you add field labor employees.
That makes sense.
Everything else, you add worst case in advance, project, you know, if I think I might, that, you know, that overhead expenses especially, then you put that in.
So just what you said there, and we're probably running short on time, and I've got so many more questions that are
Let's
coming
keep
to
rolling,
Yeah. Now that you bring that up, what do you think about recovering overhead by crew versus employees?
Well, that's fine as long as you have the same crew every time, all the time, no exceptions.
Yes.
If you ever, like, I like it by man hour, but then my antidote to the pitfall of doing it by man hour is always bid in full days. So if I work an average of 10-hour work days,
Yes.
and I have an average of 3 men on a crew, so that means my full days are increments of 30 man hours. So I will always bid in 30 man hour increments. If my bid comes in at 45, round up to 60, no exceptions. There is no such thing as half day billing because otherwise I get back to the shop at noon. What am I going to do? Start the next job? No. I mean, I guess you can, depending what type of service you provide, but always bid in full days.
For sure.
Which to me kind of then, if I'm anticipating, I think what you're thinking about bidding in crew or budgeting in crews gives me the same benefit, but then allows me to be flexible. So if I want to do a 2-man crew on that job versus a 5-man crew on that job, or bid, or bulk up a crew, or like in some bigger companies you have the luxury of having floaters. You have maybe
Yes.
a foreman and a right-hand man, and then you have floaters that they can go bounce around,
Yep.
which man-hour billing and overhead recovery is more flexible, makes more sense, it's more dynamic. Whereas with crew billing, unless you're really rigid, always do the same thing every time, which I imagine you probably are yourself. There's ways to potentially break it. Now to flip script here, on the other side of the coin is the risk of doing it by the man hour is that you only worked 15 man hours that day, and you should have worked 30. And so that means you only recovered half your overhead. And if you recover it by crew days, that almost never happens.
Right. It's
know?
more consistent, right?
Yeah.
Because you could have a 3-person crew, one employee leaves, quits just out of the whim.
Yeah.
You still have one crew,
Yeah.
even though it's just 2 people.
Yeah.
That's probably like the biggest benefit I would see.
Yeah.
Recovering by the crew.
Yeah. It is kind of simpler in a way,
It is, for sure.
especially if you're just getting started with the idea of overhead recovery. You can just be like, well,
Especially if you're an owner-operator.
yes.
Yeah.
Yeah. It's still not my preferred method, but I can see the case for it. Yeah.
Thank you for listening to today's podcast episode. Once again, thank you so much for this 2024 year. For those of you that have listened, continue to listen, or are just joining us for the first time, I thank you so much. Once again, if you want to learn more about the Headquarters software, if it's for you in your business, you can go to hthheadquarters.com. That's budgeting, estimating, job costing, time tracking, scheduling, and so much more available in that software. Or send me a message at howtohardscape on Instagram. And we want to say thank you to our sponsors.
Cycle CPA, if you're looking for bookkeeping, accounting, CFO services, reach out to Cycle CPA at cyclecpa.com. Let them know how to Hardscape sent you for money off their services there. And Knowledge Tree Consulting, if you're looking for efficiency consultants who have a lot of experience in our industry, check out Knowledge Tree Consulting at knowledgetreeconsulting.com.
And we look forward to meeting you next week on the How to Hardscape podcast.